So if you've been following disruptive technology stocks at all, you've probably heard of ARK Invest. It's run by Cathie Wood, and it's a unique investment management company that has a series of actively managed ETF funds. They have 5 active funds and 2 passive funds. The big news is that across these 5 active ETFs, ARK is actually up an average of 136% this year alone. Absolutely eye-watering returns. And that's just an average. Their genomics fund, which is their top performer, is actually up 174% year to date as I record this. If you had just bought these funds a year ago, you'd basically be a lottery winner right now. So the question is, how are they doing this when most active fund managers can't even manage to beat the broad market? And how can you and I get a piece of the action? So I've dug into their business and their investing strategy. I'd like to tell you how they've achieved these kinds of returns, and I'd like to present both a bull case and a bear case for actually investing in these ETFs. So in terms of structure, in terms of the investment products, they actually have, like I said, this family of 5 active funds that invest in different areas of disruptive technology. And they have 2 passive funds that passively track an index of broad companies. So the absolutely crazy returns are coming from these active funds, whereas their 2 passive funds have more modest returns down around the 30% annualized number, which is still incredibly good. These guys are doing really, really well across the board. Now those 5 funds are actively managed, which is kind of rare amongst ETFs. They don't simply track a passive index at all. Cathie Wood and her team are in there buying and selling every day. They'll easily execute 20 different transactions a day, sometimes a lot more than that. And so there's a lot of high turnover in these funds as they constantly rebalance their holdings, buy new companies, sell underperformers. There's a ton of active activity in here. And what's really unusual about this fund is that they release their trades every single day. And so you can easily follow what they're doing, which has gained a ton of interest among the investment community as they watch exactly how these crazy profits are being made every day. Okay, so let's look at the fun part, which is their returns. You can see a lot of these funds are up over 100%, some very close to it. And even the 5-year performance is really fantastic. They're racking in numbers even over the long term that would make any investor really, really happy to own these funds. You know, a lot of them were launched in 2014, except for the FinTech fund, which is a new addition to the family, only launched in 2019. But these 4 funds here have a solid history behind them. But really, it's this last year's performance that is capturing all the attention right now. I think people are becoming more and more aware of disruptive technology as a potential investment. And as soon as you start looking into it, you're absolutely going to discover ARK Invest, and they've attracted a lot of investor inflows. Now, if you really dig into that 5-year history of returns, you will see that the bulk of the returns came in the last year or so. If you roll the clock back and you look at early 2014 into about 2017, it wasn't all that great. They sort of floundered along. They did well enough, but they didn't really start to take off until 2017 timeframe. So in between 2017 and 2019-ish, they did quite well. Their performance was basically enhanced a lot by Tesla. Cathie Wood made a big bet on Tesla in that timeframe, and it certainly paid off a good deal within those 2 to 3 years. But then the meteoric rise absolutely starts this year, just before the pandemic, which I think interrupted that spike in their pricing, and then immediately recovered afterwards and absolutely shot up to where it is today. So I think had you invested in 2014, you would have had to have been patient to really capture the rise that only happened closer to present day. So in order to really understand what ARK is doing and how they're going about it, you need to understand the traditional analysis and investment model that used to look for technological innovation instead of disruption. So innovation happens when an existing company improves a service, develops some new tweak or some new improvement to something that was largely existing. This tends to happen within a sector or within a given industry. And rarely these innovations are big and significant, but they're still typically confined to that industry. They might shake up that industry or sector a little bit, but they generally don't have an impact across the board the way that a disruptive technology does. The very definition of a disruptive technology is that it happens across a broad base of sectors, and it has the potential to interrupt or even destroy traditional business models across many sectors. Because of that broad-based potential, The total addressable market share for a disruptive technology is not constrained by an individual sector. And this is really the key thing, is that Cathie Wood is looking for companies that have this broad-based potential across sectors to disrupt a lot of existing business and capture a mountainous amount of market share. She's looking for total addressable market numbers that are simply not achievable within a given sector based on this old traditional model of investment analysis. Now, the problem with this idea is that disruptive technologies are subject to what's called the technology S-curve, which means that in the beginning, the technology will flounder along, largely unrecognized, the potential isn't really seen, and companies that are trying to bring this stuff to light often fail. It's a really, really difficult business to be on that bleeding edge of any new technology. There's a high failure rate, and oftentimes the underlying ideas simply don't prove out and they get thrown in the garbage. And people can lose a lot of money investing in these early stage companies. But if companies can get out of that very early stage, they tend to hit the exponential part of that S-curve, and the value that they can deliver and the profits that they can bring home are absolutely meteoric during that exponential rise part of the S-curve. And then inevitably a technology will start to mature, it will level off, and the amount of growth it's capable of generating then is not as great. So really the key part of ARK's investment strategy is to try to get in on that early stage as soon as something looks viable, and then try to capture that large amount of return that's available in the sweet spot on that S-curve. Now, of course, the problem with this is that if you get in before the exponential point on the curve, you have to select companies that, as they say, can cross the chasm. And what this means is the company able to execute on their idea? Can they bring the technology to the point where they can develop a viable business around it? If they can't, then that's it. They're done, and investors could lose all of the money that they've put into these early stage companies. But if they can actually make that leap across the chasm, they have to get to that point where they're widely recognized as viable. And at that point, they can take off, and everybody that's holding them is probably going to get very rich. So how does ARK do this? How do they identify disruptive tech? How do they find it? How do they figure out if it's going to be capable of crossing that chasm? And how do they make really, really good bets to avoid the losses that you often would experience with these early adopters? Typical analysis models to identify innovation is done on a top-down basis. And what this means is that you look at the broad opportunities in the sector and then you try to find companies that can take advantage of that. So the first part of ARK's investment process is somewhat similar to this, and they do employ a top-down research approach, at least in the beginning. The difference, though, is that they are looking for disruptive innovations, and they call this the ideation phase, where they go out and look for these broad opportunities. And then the next step is to size that opportunity in terms of trying to figure out what that total addressable market share is across the entire scope of that disruption that's possible. That's the really, really difficult part. And this is where I think they draw a lot of criticism, because they inevitably come up with these absolutely gigantic estimates for total addressable market. And most people that are used to a traditional analysis model will laugh them out of the room at this point. The next phase of their process is a bottom-up research. The next phase of their process is a bottom-up approach where they take a number of candidates that they've identified, both technologies and companies, and they try to find the best ones that are at the right point in terms of an investment. And this process is somewhat iterative, where they continue to tweak it over time to make sure they're putting the right amount of money into the right opportunities. So this ideation phase is based on broad-based research. And this is the problem with identifying early disruptive companies, is that you have to find them. And it's not really easy sometimes. Sometimes you have to dig deep into the academic community. Sometimes you have to dig deep into early phase startups that don't look viable at all. How do you find these unicorns? And so the approach that ARK tends to follow is they're trying to augment traditional research sources with online and social media sources and crowdsource to really get at these underlying opportunities by talking directly to people, researchers, entrepreneurs, and folks that are involved in these really, really early stage companies, and try to learn about their ideas and their businesses before anybody else. I think if you wanted to be critical of this approach, you could say that they're using buzzwords here in terms of promoting their idea and their model, but at the end of the day, the results speak for themselves. It does appear to be working for them. So the other question is, what companies are they actually buying? What are they holding in these ETFs to generate these kinds of returns? So they actually disclose all of their holdings, and if you look at them, You can easily see the companies that are in there. What I've done here on this spreadsheet is that I have collated their top holdings across all of their funds. There are some companies that appear in more than one fund. Tesla, for example, is the top holding in 3 of their funds. And then there's some other companies that make heavily weighted appearances across the funds as well. So I've collapsed them all into this list of top 10 holdings by market value and the overall percentage that it makes up. And so you can see what these companies are, and you can see the area that they're in. I think that the take home here is the diversification. And this is what really struck me when I looked at the diversity of companies that they're actually holding and the different spaces that they're in. I think there's a lot of diversity to be had within each of these ETFs. And certainly if you were to allocate some funds across the family of ETFs, I think you'd have a surprisingly diverse holding that is probably going to be able to capture a lot of return and limit a little bit of your risk through that diversification. Now, one thing about that Tesla holding, Cathie Wood is sort of famous, or infamous even, for being one of the biggest Tesla bulls out there. She's basically been drinking the Elon Musk Kool-Aid since day one, and she has drawn a lot of criticism, I think, for this really, really passionate, over-the-top belief in Tesla and what it's capable of. But if you look at the returns that Tesla generated recently, it's really hard to argue with that approach anymore. But it's certainly proven out. I think by hitching her wagon to Tesla, she's generated an incredible amount of alpha in these funds, and I think it's gone a long way to silencing these critics. That said, I think there's still a small criticism to be made here in terms of the fact that Tesla, one holding, is responsible for a lot of the returns that you're seeing in these funds. If you were to snap your fingers and imagine that Tesla had never happened, the returns in these funds would still be fantastic, but they wouldn't be nearly the numbers that she's racked in today. Personally, I don't put a lot of stock in that. If you look at some of these other holdings, they've also generated some pretty fantastic returns. And I think even had you removed the Tesla returns out of the picture, you'd still be really, really happy that you had held ARK through those timeframes. Another consideration for the bull case here is that this idea of total addressable market size is potentially going to come true given this acceleration in terms of the underlying trends. I think some of the incredible numbers for overall market share that ARK is projecting are looking a heck of a lot more reasonable now that we've seen this acceleration in these trends. Let's talk about risk. So what's the bear case for the ARK funds? Well, right off the bat, I think you have to recognize the amount of promotion that ARK is doing out there, and you have to question it just a little bit. I think investors are nervous that there's a pump and dump story happening in some of the holdings that ARK is investing in. Personally, I don't think that's true. I think that they're mistaking the media presence that Cathie Wood and her team is putting out there as sales promotion. I don't think it's necessarily that. I actually think that that is in line with their strategy of connecting with disruptive startups through social media and crowdsourcing. You can't connect with these people unless you're out there. You want publicity, you want a little bit of sensationalism around your company so that you can make the contacts you need with these early stage opportunities. Another criticism about ARK and these disruptive technology trends in general is the potential for a bubble. Certainly it does seem reminiscent to me of the talk that I heard during the dot-com bubble. I lived through that period, I invested through that period, and it was all the same talk about this time it's different. These disruptive technologies are going to change the world. Old ideas about market share don't apply anymore. The old rules need to be thrown out the window. This is a new world. All of those things were said back then, and we saw what happened. I have to say, though, that I really find the story compelling. Even having lived through that time period, I'm looking at the differences now in terms of this broad base of disruptive technologies. Back then, it was really just the one. It was internet-based services, right? And now there's at least these 5 broadly identified disruptive technologies that are all happening at the same time, and that's the key thing. So what's the final word? Well, I think that if you invest in ARK, you are placing a bet on Cathie Wood's ability to ride the technology S-curve. How good is she and her team at picking out those early stage companies, filtering out the ones that can't cross the chasm, and then capturing those enormous returns from the ones that have. She does have a track record for doing it, and personally, I believe she's going to continue to do it. I really hope she has a solid team behind her, because otherwise we're relying on the judgment of just one person, which is not a great idea to go forward. That said, I do think there are some really, really smart people at ARK aside from just Cathie Wood. At the end of the day, if you're interested in aggressive growth right now in disruptive technology, ARK is a one-stop shop. I really can't see an argument for going anywhere else. And I would absolutely say that ARK is a no-brainer buy for that aggressive growth part of anybody's portfolio. So that's it, guys. That's the deal. I hope you enjoyed this one. Please give the video a like, subscribe if you haven't, ring the bell, and I'll see you on the next one.